of us. So what I'm going to do is go through kind of a state of the state for GSV Capital, talk about some of the fundamental trends that are going on for our business, and lastly talk about some of the what I call gravitational shifts that are taking place that are creating opportunities for us and our shareholders. So first, 2016 in review. New investments. We had a $4 million investment in Snap in 2016. Obviously, Snap went public in March of this year. It was the largest IPO, $3.4 billion in technology in the last 5 years before Facebook. Facebook was a $15 billion IPO 5 years ago. GSVC owned Snapchat at $15.37 a share. As of last night, Snap's trading at $20.34. We think Snapchat really is a transformational business in media. 166 million engaged monthly active users, 35,000 snaps per second. There's 10 billion plus videos watched every single day on Snap. But when you look at demographically and look at where the future is, it's, looking at young people as a window to that future. And look at the 18 to 34-year-old demographic. 45% of all people in that demographic are on Snap. This is 9 times greater than the 15 largest TV networks combined. A second investment we made in 2016 was Lytro, which was a follow-on investment of $3 million. Lytro has game-changing technology, what I call selling picks and shovels to the virtual reality miners. When you look at what's going on in virtual reality and augmented reality, it's wildly exciting. Last summer when Pokemon Go introduced themselves in July, they had 500 million downloads in 2 months, the fastest growing game in the history of the world. So looking at virtual reality and augmented reality, we expect that category to go from $1 billion today to $80 billion by 2025. A third follow-on investment was in Curious, $2 million. Curious is creating bite-sized, everyday learning platform. Today, 25,000 lessons. Forbes called them the Netflix for learning. Ozzy Media, we have a $2 million follow-on investment. Ozzy is a new media business focused on what's new and what's next. It's really focused on the change generation. Carlos Watson, the founder and CEO of Ozzy, was supposed to present today. He had to chase some business down in Berlin, so he's in Berlin, and they obviously can't be here, but we're very impressed by what they've been able to do in a short period of time. It's really a three-legged media platform with digital news, again focused on what's new and what's next. TV, which is fairly remarkable for a business that's just a little over 3 years old. You might have seen The Contenders was a program that they created for PBS on prime time. They've got 3 different series that are different forms of production. And then Ozzy Fest, which takes place in Central Park, had over 3,000 people attend. And again, really interesting business. A lot of nice things said about them from other media companies. 25 million person audience. To put that in context, that's larger than The Economist, The New Yorker, and Politico. So in terms of 2016 net realized gains and losses, we had realized gains of $4.7 million in 2016. We had losses of $7.1 million, produced a net loss of $2.4 million for the year. We had a $4.4 million gain in Lyft. We've taken the opportunity as Lyft shares have risen. We've taken the opportunity for significant demand in those shares to effectively get our money back and let the rest ride. Sorry for the pun. Lyft, the return that we've made on Lyft to date is a 48% IRR. And our current value for Lyft shares is $7.3 million. Lyft, subsequent to our recent calculation for NAV, which is March 31st, did a $500 million financing at $7.5 billion. So it's likely at the end of June, our Lyft shares will be marked up from that $7 million position that I referenced. So when you look at the business of Lyft, it's absolutely taking off in an incredible way. Some of that is from the kind of self-inflicted wounds that Uber has experienced. Some of it is that Lyft just has a different value proposition for a lot of riders, and where they're really doing well is with women. So in 2016, they had 163 million rides. This is a 3x increase over the year before. And we see the numbers every single month, and what you're seeing with their business is it's actually accelerating. And in 2017, Lyft's going to be in 100 new cities. So again, we're very excited about the future prospect for Lyft. In terms of the not as fun stuff to talk about, we recognize a $6.2 million loss in Gilt Group. We had actually marked down our position to Gilt to kind of fractional value a couple years ago, but we actually realized the loss last year, $6.2 million. Then after December 31st, we took the opportunity. We're very bullish on how we're positioned at GSV Capital, but we took the opportunity to really take a fresh look at the portfolio, things that have gone on, and in what was a way to effectively, clean out some brush. And so we recognized another $25 million of losses after December 31st. And so that's the bad news. The good news is, again, I think what we've got is a portfolio of companies with very strong fundamentals and positioned to stock that we think can perform extremely well from here. In addition to things that we're doing to improve the business, is we brought in 2 new board members with extensive experience in the investment business. Dave Potrick is our most recent new board member, who officially joined the board just about a week ago. Dave was the former CEO of Charles Schwab, is on the board of Intel, and is the chairman of Hightower, which is a $35 billion wealth management firm. Dave is also an author, as well as a professor at Wharton, and a great advisor for us to have on our board. Additionally, in the room we got Mark Mazur, who is a former executive at Goldman Sachs, was the CEO of Brevin Howard North America, which is a large London-based hedge fund. And Mark, again, brings extensive experience to helping us produce the kind of returns and performance that you should expect. In terms of the state of play of the portfolio, today we have 39 investments. One of the things that we talked about last year was that we were going to reduce the number of companies that we had involvement with and really concentrate our positions in the companies that we had the greatest confidence in. So last year at this time, we were an investor in over 50 companies. Today, it's 39. $195 million of net assets. The Q1 net asset value, $8.83 a share. So with our stock currently selling at about $4.50, we're selling at approximately a 50% discount to NAV, which we're hoping to change that relationship and those dynamics. Incredibly positive for us, we believe, is the fundamentals of the portfolio are very, very strong. In 2016, the revenue growth of the portfolio was 110% year over year. Additionally, one of the things that we've demonstrated is our ability to invest alongside of or behind of the top venture capital firms in the world. So if you look at our portfolio and in the 39 investments that we have, you can see that 12 of our portfolio companies have Kleiner Perkins as a sponsor. 8 have NEA, IVP, Benchmark. So being able to work alongside with the very best venture capitals we think is a great advantage for our shareholders. Another thing that we talked about before, and we're demonstrating this, is the focus on emerging growth companies, not early stage businesses, but really after they get to the emerging growth stage. Historically, we had predominantly focused on emerging growth stage, but we made venture investments, and we think for this particular fund, it's much better for us in terms of visibility and volatility to focus on later stage, and you're starting to see that reflect in the portfolio. So 93% of the portfolio is in B round and beyond financings. And about 2/3 of the portfolio is in primary investments, and 1/3 is in secondary. Something that you should expect as you look forward is I think the secondary component is going to increase. And the reason for that is we feel like we at GSV have advantages in our ability to access and analyze and get opportunity in the secondary market that is significantly different than others, and we think that will ultimately benefit our shareholders in a material way. So prediction, because we're going to invest in the best companies that we get access to at values that we think are attractive, but a prediction is that you'll see the secondary component increase from the 34% that it's today. And in terms of the 5 sectors that we focused on, education technology is largest at 37%, big data and cloud is 34%, social mobile is 18%, marketplace is at 10%, and sustainability at 6%. And I'll talk at the end of my presentation about how we see themes evolving, where we see the most attractive opportunities today and our view towards the future. Our top 10 positions in the portfolio are actually 60% of it. So when you try to get a feel for what's in the portfolio and is it attractively valued, you literally know what 60% of it is in our top 10 positions, many of which are pretty visible names. And so it really is a approach where we're trying to concentrate our investments in the companies that we think have the strongest fundamentals and will create the greatest long-term returns. Our top 3 positions, Palantir, Spotify, and Dropbox, are 28% of the portfolio, and we're wildly bullish on those 3 companies. Now, one of the reasons I believe our shares are selling at a discount to NAV, a substantial discount to NAV, is just the unfamiliarity with the process that we go through to calculate NAV. I think it's a natural reaction to say these are private companies. This must be sort of a, much more of an art than a science. I think what's important to appreciate is the rigorous process that we go through to provide value on the portfolio every single quarter. It starts with our team going through every single security and looking at everything from the performance of the company to institutional trades and marks and financings, and that comes up with one perspective in terms of NAV. Our independent auditor, Deloitte, has reviewed the process. When they see discrepancies, they'll bring it up in terms of how things are done and things that maybe a different way to look at something. And then, but not to be outdone, our independent board has hired a valuation firm, Anderson Tax, which is the largest valuation firm in the world, and they go through their own rigorous process, and when there's differences, material differences, the board makes a decision which they think is the most appropriate. And again, we think this process has great integrity to it, and we think it should give people confidence that when you see an 883 NAV, that's a good price. Some of the fundamentals driving our opportunity, the first is supply and demand. And so in 2000, there was one unicorn, a unicorn being a private VC-backed company with $1 billion greater market value. And it was called a unicorn because it was such an unusual, exceptional thing. As of last week, there were 200 unicorns in the marketplace, which some people's reaction to that is, well, that just shows that the world's gone mad again. But I think it's really a function of the changing fundamentals and supply-demand equation that's going on in the marketplace and the digital infrastructure that has been developed over the past 20 years. So you look at, from a capital markets perspective, during the decade of the 1990s, there was 406 IPOs on average per year. The last 15 years, there's been 108 IPOs per year. Last year, there was 102. So nearly an 80% reduction in the number of IPOs. The time from VC investment to monetization has gone from 3.1 years to 10 years. And the size of companies going public has more than tripled. So it's effectively happened is you had a longer time from investment to monetization. Companies going public are larger, more mature, and it creates all sorts of different issues and opportunities as it relates to for the companies themselves and for investors that want to access them. So last year, there were just 40 VC-backed companies that were able to go public. Over the last 15 years, on average, venture capitalists have invested in 3,500 companies per year. So our estimate is that there's 2,000 VC-backed private companies with $100 million or greater market value, which we think is both extraordinary as well as exciting. And so as you kind of go through this funnel, we estimate in the last 10 years there's roughly 35,000 companies that have been funded. Of those 35,000, there's 16,000 or so that are alive in some form or fashion. As I referenced, 2,000 of them have $100 million great market value, which we really look at as our universe. And then of those, about 250 that we have gone through our process of what we think could be attractive for us from an investment opportunity. And there's roughly 25 of those or so that we have extensive due diligence that we've already conducted on the companies well before financing. And we actually published this list of 250 in a list called the Pioneer 250. So if you pay close attention to us, you see that we put a lot of our research out in the form of publications, which we hope not only provides insight into how we think, but also just it gives you that opportunity to see the most exciting companies in the marketplace. So if you look at the opportunity for us, really, I mean, the power alley basically is the stage of a company where it went public historically to where it goes public today. That's the GSV capital opportunity, and it's an enormous opportunity. Also, from a supply-demand standpoint, in terms of what's going on in the world, corporations are flush with cash. There's $2.2 trillion in balance sheets of corporations. And you look at what's going on in the technology world, like a lot of other industries, technology is going through a massive consolidation wave today, with the leading platforms effectively looking out to fill out their product roadmap by making acquisitions typically from startups, and a lot of them here at GSV Labs. And that's why you see 25 corporations that are actually physically located here, because they want to get a window to what's going on and have access to these opportunities to fill up their product map. So all in all, the technology platforms in the last 6 years have made over 500 acquisitions, representing $170 billion, if we get that to work, in transaction value during that period of time. When you look at, I'm sorry, this is not working very well. If you look at the reduction in the number of publicly traded companies, there's actually been a 50% reduction in the last 20 years of publicly traded companies. So there's a big demand imbalance. If as a growth investor, how do you get access to the most dynamic, fastest growing companies in the world? It's increasingly tough. There's not IPOs, there's not publicly traded companies have been reduced dramatically. And how do you access the private markets? That's how we think GSV Capital is ideally positioned to capture that opportunity. The second key fundamental that's going on, which is really exciting, is the rapid value creation you're seeing in businesses, and specifically technology businesses. So in 1994, Mark Andreessen was the co-founder of Netscape, effectively bringing the internet to the people. And over the last 23 years, the digital tracks have been laid with now 3.4 billion people on the internet currently. You also have the fundamentals of computer costs have fallen 99% during that same period of time. Storage cost is essentially free with infinite capacity. You've had 2.8 billion smartphones now in the marketplace. Last year alone, there was 258 billion apps downloaded. So what this lets happen is an entrepreneur with an idea can reach millions and tens of millions of people at breathtaking speeds. And you're seeing that going on with businesses all over the place. Also in 1994, not coincidentally, Amazon was born. And Amazon has been a major disruptor in many areas of business, but the retail business is nothing short of remarkable. So Sears in 1994 had a $16 billion market cap. At one point, Sears was the largest retailer in the world. Today, Sears' market value is $1 billion, and recently announced that they might have to file for bankruptcy to keep away from creditors. Amazon today has a $450 billion market cap, but it's not just Sears, it's Target, it's Best Buy, it's Macy's. The retailers' market value over the last 10 years has decreased 60%, over $100 billion, and even more remarkably to me, since October, there's been 100,000 jobs eliminated from department stores. So, to put some perspective on that, that's more than the total number of coal miners employed in the United States. And so, when people talk about, gosh, they're worried about what's going to happen to the coal industry and the coal miners, what they really should be worried about is what's going to happen to all these people that worked at retail stores. In terms of the rapid value creation, let's use Uber as an example. It's probably not a fair example because it is the fastest growing business in the history of the world, and it literally is. But when you look at February 2012, Uber was financed at a $347 million market value. Just a year later, that value had increased to $3.7 billion. A year after that, increased another $15 billion. And today, $67 billion market value, and Uber was started 8 years ago. Airbnb, the Series B financing in July 2011, $1.3 billion. Series Z, 4 years later, $26 billion, $25 billion of value had been created in a startup, in 4 years. If you look at Lyft, Lyft is going along a trajectory similar to Uber in terms of growth. We invested initially at the $950 million Series D. We also invested in the Series E at $3.2 billion. As I mentioned, in April, financed at $7.5 billion. You look at the progression of Snapchat. In the Series A at $84 million. In February 2013, this business was just started in 2011. IPO value, $24 billion. And again, what the fundamentals behind this is that you have this digital infrastructure that's been created that lets you have that type of speed to market and speed to value creation. And that's what we're looking to participate in. So again, the value creation opportunity for us is in that zone where a company has demonstrated their commercial model, and then it's a function of blowing it out, and that's when we want to get involved. Our fundamental core belief at GSV, supported by years and years of research, is that growth, revenue and earnings growth, is what drives enterprise value over time. In fact, over a long period of time, they're essentially 100% correlated. You can see this in the public market. Priceline, his stock grew at 41% the last 10 years. That's because its earnings grew at 38% during that same period of time. Apple's stock grew at 25%. That's because its earnings grew at 32% during that period of time. And Google had slower EPS growth of 17%. Well, its stock also grew at a slower rate at 15%. But you see how that correlation happens. And so we're looking to invest in the fastest growing, most dynamic companies in the world. That's our focus, and we believe that will ultimately be well rewarded in terms of both performance and our stock price. Talking about the IPO world, as we've referenced a few times, there's been a drought in IPO, not just a few years, it's really 15 years, and you've had this massive buildup which creates an opportunity. But we're seeing signs of life in terms of the IPO market today. You've had 62 IPOs year to date. But importantly, the correlation between how NASDAQ performs and then the companies coming public, you have NASDAQ that's significantly outperforming for the first time in a long time. And you're seeing companies that are testing the water, they're seeing the water's good, and there's a big pipeline of companies looking to go public. So we think that can be very positive for us. You see that a number of different pundits have predicted some of our portfolio companies as 2017 IPOs. With obviously everybody, since Snapchat's already public, they all predicted Snapchat was going public. But others, Palantir, Spotify, Dropbox, Lyft, these are all companies that certainly are at a stage where they could go public if they so chose. And with the environment looking healthy, we think it's not unlikely. As I mentioned, education technology is our largest sector commitment. CB Insights has said that sector actually has the most number of companies that they think could go public in 2017. So we think that's positive for us as well. And why the IPO market's so important to us is that we think it's an important catalyst for our stock. So if you look at GSV Capital stock in its history, we've sold at a premium a couple times when Facebook went public, and we had a meaningful position in Facebook. And when Twitter went public, we sold a premium to our NAV. With a handful of really high-profile, important companies that we think could go public, we think that could be a great catalyst for our shares. We also show a $2.76 per share dividend that we provided just over a year ago. So on a $4.50 stock, if we could do that again, I think that'd probably be helpful for our stock price too. What do you think? I'm going to close my talk just with some gravitational shifts that we see taking place in the world that are creating opportunities for us as investors. The first gravitational shift is what I call digital natives rule. So the class of 2020, which is the group of students that went to college last fall, are very different than any class before it. So obviously they were born 18 years ago, which also 18 years ago was when Google was born in the garage by Larry Page and Sergey Brin. And so this class of 2020 is grown up in a world where information was free and ubiquitous. My generation, information was expensive and water was free, but things have changed a little bit. Also, 18 years ago, Steve Jobs came back for a second tour at Apple with his original goal of putting a computer on everybody's desk, but ultimately to put a computer in your pocket. So this class of 2020 doesn't think of it as a smartphone, it's just a phone and they do everything with it. So whether it's transportation or getting their food or buying products or watching the entertainment, that's what they expect. And not only do they expect to be able to do it from their phone, they want to do it when they want to do it, where they want to do it. So this on-demand mentality is just what they've grown up in, what they lived in. So you look at Netflix, kind of the binge watching that goes on, so you don't have to wait a week to watch your favorite series. You can watch it ongoing basis. That's what is supposed to be normal. So it's not a coincidence that this class of 2020 thinks it's absurd that they got to go to their economics 101 class on Thursday morning at 8 o'clock. Why shouldn't they be able to take the class when they want to take it, where they want to take it? And in fact, 50% of the class of 2020 thinks that online learning is as good or better than in-class learning. So this class of 2020, they love everything about technology. They have no memory of the dot-com bubble bursting, but they do have a memory of how their friend's family lost their house in the financial crisis of 2007, 2008. And so millennials aren't buying houses. About a 30% reduction in the number of homes owned by that demographic. In fact, the millennials don't want to own anything, including cars. So last year, there were more cars sold to people over the age of 75 than 18 to 24-year-olds. This class of 2020 also remembers how their parents lost their job at the company they worked for their entire career and the pension along with it. And so the Department of Labor estimates this class of 2020 is going to have 15 different types of careers between when they graduate from college and they retire. And one of those jobs could be part of the gig economy as a Lyft driver. So in other words, basically, they don't want to own anything, but they're happy to share it. The second gravitational shift is geographic, both physical and virtual. So when you look in the rearview mirror, the last 100 years, the economic engines for the world was the United States, Canada, Europe, and Canada. And so those countries were about 9% of the global population, but 52% of global GDP. Look at first you look at the growth of those countries the last 15 years, it's basically flat. So you had no growth from the economic engines of the world from a historic perspective. Demographically, those countries are getting old. 26% of the population is older than the age of 60. Just 15% is younger than 15. And so last year in Japan, there were more adult diapers sold than baby diapers. The fertility rate of those countries is 1.6 times. So to keep a constant population, you need 2 times or greater. So literally, these countries are dying. And 41% of global GDP today versus 52% 15 years before that. As we look over the windshield into the horizon, what we see emerging is what we call the V-chips, which is Vietnam, China, India, Indonesia, and the Philippines, as the new engines for the global economy. So these countries today are 43% of the global population, and while just 28% of global GDP today, it's grown at 8% per year for the last 15 years. Demographically, basically the mirror opposite of the countries I referenced before. Just 11% of the population older than 60, 24% of the population under 15. From a fertility standpoint, 2.3 times, so they're organically growing. And so when you look at the old center of gravity, it looks sort of like this from an economic standpoint. The new center of gravity looks like this. And you want to see what's on deck? Africa last year had 5 of the 10 fastest growing countries in the world. And when people talk about China, and they say, well, that's kind of yesterday's news. China's not, China was a great growth story, but that's sort of behind them. You're ignoring major trends that are going on, including the fact that they're a leader in mobile, they're a leader in education, and this mega trend of urbanization. China's crazy. So you look at that in the United States, you got 10 cities with 1 million or more people. In China, it's 160. Here's Shanghai in 1990. Here's Shanghai today. So the official population of Shanghai is 24 million people. But demographers looking at things like cell phone traffic and so forth say it's actually more like 40 million. To put context on that, that's larger than Canada. So Xi'an has a population of 13 million people. It's the 10th largest city in China. And you've never heard of it, right? It's larger than Sweden. So this is what middle class consumption looks like in 2015. Pretty equal between North America and Asia Pacific, but based on this growth of the middle class and where it's happening, here's what it looks like by 2030. So for a technology business, for consumer business, I mean, this is something that is absolutely fundamental to the future opportunities. You know a lot about a country by how they spend their money, by people how they spend their money. So if you look at the US, 33% of a family's income spent on housing. In Asia, it's just 10%. Look what's spent on education. United States, it's 2%. In Asia, 7 times greater. So a recent trip, when I was in China, I read the South China Morning Post. By the way, it's a great newspaper. It's owned by Alibaba. And the front page story of the South China Morning Post when I was there was about this myopia epidemic in China that's taking place, they think, because the students are studying so hard. In fact, by the time they get to college, 90% of all Chinese students are nearsighted. Looking at from a company standpoint, just 25 years ago, here are the 5 largest market cap companies in the world: Exxon, Philip Morris, Walmart, General Electric, Merck. Many industrial, most had started 100 years or more before it. Look at the 5 largest market cap companies in the world today. It's Apple, Alphabet, Microsoft, Amazon, Facebook. 3 of these 5 are located within 10 miles of our office here. And when you look at 9, 10, and 21, Tencent, Alibaba, and China Mobile, what's so interesting is, one, obviously they're from China and largest market cap companies in the world, but these companies didn't exist 20 years ago. So it's super exciting for us, and obviously GSV stands for Global Silicon Valley, is the mindset of innovation entrepreneurship that has made this such a remarkable area, is going global and is going viral. So I like to say, the Global Silicon Valley is from Austin to Boston, from Chicago to Sao Paulo, from Mumbai to Shanghai to Dubai. That's the Global Silicon Valley. So in the back of the room, we just published a book called the Global Silicon Valley Handbook. It's a little bit tongue-in-cheek, but it's mapping out the innovation markets around the world, effectively what the activity is, who you need to know, and so forth. We had, if you watch HBO, who watches HBO's Silicon Valley show? It's awesome, right? So we had TJ Miller at an event that we had, who's Erlich Bachman, the purveyor of his own incubator. And so he saw the Global Silicon Valley Handbook and he gave us this quote: "One of the most ridiculous but informative books I've ever read." So I'll take that as an endorsement. Last gravitational shift I'm going to talk about is automation in the knowledge economy. So historically, the blue-collar worker was the heart and soul of the middle class. But the blue-collar worker is under siege from technology and automation. Amazon alone, quote-unquote, employs 45,000 robots. So McKinsey estimates that 350 million global manufacturing and warehouse workers' jobs are at risk. But it's not just blue-collar workers, it's also white-collar workers. And it's not just, things that you think are mundane jobs. There's 12 million middle skills jobs expected to be eliminated by 2025, again, according to McKinsey. And what are these jobs? $7 trillion is expected to be managed by robots by 2025. Already, the Associated Press has 3,000 companies that they do financial reporting on every single quarter. So what does that mean in the future? Money is going to be managed by robots, making decisions based on what other robots are telling them. That's the future. So add it all up, and 50% of all jobs are at risk of replacement in the next 20 years. So smart people like Mark Zuckerberg says, you should become a programmer because he'll hire every great programmer he can find. There's 1.2 million open computer science job openings by 2020. No less an expert than the Harvard Business Review says that data science is the sexiest job of the 21st century, and it's sexy because there's a bunch of high-demand, high-paying jobs in that category. The problem with this logic is this graph. So what this shows is human capability grows on a linear curve, but technology is on an exponential curve, and we're here. So what this basically means is pretty soon technology will replace the technologist Or in other words, it's not just the blue-collar jobs and not just the white-collar jobs, it's also the no-collar jobs. So the killer jobs of today will be killed tomorrow. So as sure as the sun comes up in the east, we know that automation is going to continue to eat jobs, but it doesn't eat work. So one of the fundamentals of the future of this knowledge economy is no longer you're going to be able to fill up your knowledge tank to age 25 and drive off through life. You're going to continually need to replenish that. And so the old system, which was created around 1900, was you had played from 0 to 5, you learned from 5 to 25, you had a job from 25 to 65, and they retired at 65. The new system is basically you're going to learn from the time you're born to the time you retire, if you ever retire. And so what we see as key and what's exciting to us is you're seeing, because of this digital infrastructure that's been laid, because of the needs in a global marketplace and knowledge-based economy where education makes a difference, not only an individual does, but how a company does, and for that matter, how well a country does. What's exciting to us is you're seeing for the first time what's being developed, what we call weapons of mass instruction. And what weapons of mass instruction are businesses that are able to reach millions of people to help them learn what they need to know to participate in the future. A great example of this, and I'll have the privilege of introducing Rick Levin in a second, Coursera, which announced $64 million financing today, which GSV proudly participated in, is providing education to 26 million students around the world. It's a 5-year-old company, the largest learning platform in the world. 150 universities partnered with 2,000 courses made available online, all for free. And so you can talk about how that business model works in a second, but it's wildly disruptive, wildly exciting business. So as we think about what companies and areas we want to focus on, we see all these dots up there. There's a lot of noise. And we see things from Trump to machine learning to brain science to virtual reality to everything's free. And so what we're trying to do is really connect these dots and think about what this means and where this is all going. So as we talk about the 5 themes that we have focused on historically, cloud and big data, we'll really see emerging as artificial intelligence, robotics, blockchain, AR, VR. And sustainability, it's not just about green technology, it's about water, it's about wellness. Social mobile, you know, it's been a great area for us, but Internet of Things and digital doctors are wildly exciting. The opportunities are being created there. Marketplaces, you know, peer-to-peer is you know, the way of the future and the way of marketplaces. In education technology, here's a theme that we've really been focused on and we're really excited about. Is, you know, we talk about traditional network effects businesses, and we love network effects businesses. The network effects here is about connecting people, ideas, and opportunities to create exponential outcomes, let people participate in the future. And so as we think about education network effects, you got talent on the supply side of the equation, you got work on the demand side, but here's an interesting reality. In the United States, just 30% of the US adult population has a college degree or better. So in the middle, we create learning, education, and connecting talent to work through education. So our network effects is networking, education, talent to work, and that's our network effects, and we think that's going to create explosive opportunities.